What's up, everyone? Welcome to the daily macro update for Tuesday, December 2nd. Taking a look at the macro data for today, we were supposed to get job openings today, but ended up not getting that because the government decided not to produce it, even though the government shutdown is over. So the numbers must have been pretty abysmal for them to not want to release it, but not going to speculate on that. What we do have here is the only major one today, which is that we received the economic optimism index from Real Clear Markets, which showed a pretty decent rebound from the previous month here. And so there could have just been a little bit of a blip there in November, but it's pretty much back to where it was over the past average for the year. And so let me zoom out actually a little bit just so that you can see that better there. But yeah, so I mean, we were supposed to get job openings and we're not going to get it. So not sure why that's happening, but it's pretty clear that the government at this point is trying to delay as much as possible the abysmal market data. And you can only do that for too long because people are going to get upset. But, we're not going to speculate too much on what could and should happen. We're going to just work with the data that we are receiving right now, which at the timing of this video, there is a pretty decent shift in the markets. The stock market is trying to feel out right now if we are going to end up achieving a soft landing, even with sticky inflation. And so really what the market is pricing in is inflation remaining higher than average, as well as the Fed cutting rates into that. And so we've been talking about this for the past several weeks, and it's something where the Fed could be making a historical mistake right here because the inflation numbers are not progressing at least towards their 2% target, yet the labor market is really deteriorating. And we've talked about this before with the labor market where there is more of a supply change rather than a demand change. And I think really there is low demand as well. So, for people who are looking for jobs, it is a tough jobs market out there. But also the supply of workers has gone down as well. So both demand and supply have gone down at the same time. And so that creates an equilibrium point that is much lower, which is showing that the labor market could be sustained at a much lower level. So I'm not sure why they wouldn't just produce those numbers because, the government really wants the Fed to reduce rates as fast as possible. So wouldn't you want to produce those jobs numbers if they're going to help with the case for reducing rates? Maybe the jobs markets are actually showing a decent recovery, and that's the reason why they're not, displaying those numbers, because it would reinforce the Fed not cutting rates as fast. That could be the case. We won't know until the numbers officially come out, but that could be the case given that this administration severely wants the Fed to continue to cut rates. And the only way to do that is, as of right now, if you're not going to give out labor market data, the only reason why the Fed would cut rates is if inflation was coming back down to their 2% target. So, the target rate probabilities here for the Fed meeting next week is showing an 87% chance that they're going to cut by 25 basis points. But what is the real reason? If inflation, the target at least for inflation, is, near 3% for the month of December and accelerating, then why would the Fed, put lighter fluid on that fire, right? Doesn't necessarily make sense to me, but in terms of the reason why or what we think should happen, it doesn't necessarily matter for what we are trying to do, which is actually make money in the markets. And so, all we can do as surfers is ride the wave. We can't create the waves, right? And so this is really getting back to this no landing stop go cycle, which I'm sure you've seen before. But we've covered this in other videos. But right now it seems to be that we are in this or beginning to go into a go phase, which is what our team calls it, where we start to get a more dovish Fed being priced into the markets. We're getting rate cuts being priced into the markets. Stocks might have a decent rally into that, as well as we're getting more of a soft landing optimism with that as well. Now, unfortunately, the consequence of this is that it's going to cause inflation to also rise, because all of this activity is a stimulant. And if there's a lot of activity in the markets, it's going to raise inflation. And so, again, this entire no landing stop go cycle has been pretty much been going on since 2023. The only way out of this really is either a hard landing, which that's what's the most probable case, or we just grow our way out of it, which is still possible but pretty unlikely. And the bond market has been reflecting this as well. One thing that I sent out here this morning on Twitter was that ever since the Fed started cutting interest rates all the way back at the September meeting, so that's when they started rate cuts 2.0, what have interest rates ended up doing? They've actually ended up just going sideways. And so let me actually bring this up on the charts here so you can see that better. But ever since the Fed started cutting rates on September 17th, the interest rate, or the 10-year U.S. government bond yield, which is the yield in which all of the rates that you and I are familiar with paying, things like credit card bills or credit card APR, as well as 30-year fixed mortgage rates in order to buy a home, those things more closely track the 10-year U.S. government bond yield and not the effective federal funds rate, which is what the Fed controls when they are lowering or raising interest rates. They're two separate things that you have to keep in mind. And even too, like if you talk with your local real estate agent, they're saying, hey, the Fed is lowering rates. Well, that doesn't necessarily mean that you're going to get a better interest rate on your mortgage, on your housing loan, because those rates most closely follow the 10-year here. And as you can see, they've remained pretty flat to slightly up since they started cutting rates in September of this year. And now that's not as dramatic as a reaction as we saw last year when the Fed cut rates on September 17th, 2024, whereas interest rates actually went up pretty violently. Now, at least, they're just cutting rates, and, yields or interest rates have pretty much halted from where they're at. Now, this is because we are definitely in a different regime where liquidity is becoming tighter, as well as we are seeing a much different story with the labor market. But it is interesting as, rates have pretty much remained flat since they started cutting. And so this is a great reminder that, the bond market could revolt against the policies that are being made between Washington as well as the Federal Reserve. And if you have what's called the bond vigilantes take over and the 10-year bond yield actually rises as they cut rates because of inflation fears, well, that could cause a huge amount of problems in the medium term. Now, in the short term, that could cause a little bit of a rally in some inflationary type of assets like Bitcoin, which is kind of what we've been seeing over the past 24 hours here, as Bitcoin has had a pretty decent recovery from the sell-off from yesterday, forming in an immediate term higher low right here, which is what we consider less bad, technical term. But this is all happening on accelerating volume, which is actually some good news. Now, that doesn't mean go ahead and ape into Bitcoin, because it's still a bearish trend in our model. But with this move, it has become marginally less bearish, which is a positive rate of change. We will be keeping a very close eye on Bitcoin. We'll see if this continues. If we get another day with higher volume as well as higher prices from here, then we could be seeing Bitcoin reclaim a neutral trend from bearish, which in that case, that would probably be a buying signal. So that's something to keep in mind. Not seeing that just yet, so don't go out there and just ape into it. But that's what we are seeing right now. Okay, and then things that are having a little bit of a a little bit of a drawdown, not really a drawdown, but a little bit of a pressure relief from the large acceleration is things like silver. Well, not really. You'd have a little bit of a buying opportunity, but silver continues to just go crazy. And then gold is having a little bit of a buying opportunity. I was buying a little bit there this morning on that dip, but gold and silver continue to be the big players. Silver being the absolute best performer this year so far. If we wanted to put up a chart here, let's go ahead and bring up a chart of SLV. And then let's go ahead and bring up gold. We'll bring up the ETF GLD. We'll put that as a percent scale. And then let's also bring up the S&P 500 with the ETF SPY. And then let's also bring up Bitcoin. So let's take a look at these in comparison on a year-to-date basis. So yeah, as you can see right here, year-to-date, silver is up over 98%, nearly a doubling, right? That's the ticker here. Gold, which is in blue, is up 57.78% year to date. The S&P 500 is up 16%. And then Bitcoin year to date is down 6%. So that is pretty interesting there, seeing that, Bitcoin is down, the S&P is slightly up, and then you saw a huge acceleration in precious metals. This year, if you were to characterize it, would be a year of stagflation, because again, Bitcoin does incredibly well when inflation is accelerating, which, we may have saw different pockets of that throughout the year, but overall it has pretty much, gone flat. And so that's what we are seeing right now. So yeah, 2025 is seen as the year of stagflation, which is interesting because if you kind of take a step back and you think of this in terms of a total cycle, right? We saw how in 2021, explosive growth, 2022, bear market, 2023 and 2024, pretty significant rally from there. And then in 2025, we're kind of seeing the momentum shift and slow down in terms of risk assets. And this is also because of the tightening in the liquidity markets. That is also a significant factor. And the analogy, and I want to try and come up with some graphics for this just to give an illustration. But what I like to try and picture is a bathtub, and you can think of that as the amount of, a bathtub full of water, which is the amount of liquidity that's currently in the system. And now this is a special bathtub that has two faucets. We'll call one of the faucets the government and the other faucet the Federal Reserve. And then it also has two drains. You can have one drain be quantitative tightening, and then you can have the other drain be taxes from the government. And so from what we've been seeing since the pandemic, right after the pandemic, you had both faucets, both the government and the Federal Reserve, being turned all the way to the left on full blast, trying to fill up that bathtub. And then once it got to a pretty full level, like we saw in 2021, then they had a change in policy where they opened up the drains. Now they didn't stop with the filling up the bathtub with new water, because during that time, that transition period, yes, the drains were opened up for quantitative tightening, but the taxes drain remained sealed, and it still is. And the government faucet continues in full blast because they are just continuously, printing money with their treasury bill issuance. And this will make sense. I'm going to try and see if I can get like ChatGPT to like help make me an illustration of this, but I'm sure you guys can picture it. It's not that hard. And so now we are in a phase where, yes, quantitative tightening has stopped. So they've plugged that drain, but both the government faucet as well as the Federal Reserve faucet is also at a very slower level, right? So it's pretty much at a drip at this point, which means you pretty much have a stagnant tub, right? A tub with stagnant water. And that rate of change is actually negative for liquidity, which could pose some risks heading into 2026, because in this liquidity environment, that's a negative rate of change. So that's the biggest risk that I'm seeing in 2026. Whereas we could have a more deflationary type of environment, right? So we had two explosive, good years of in 2023 and 2024 of returns in the market. Now we're starting to slow down a little bit. And so next year, especially with it being a midterms year, which the market on average doesn't do very well, we observing averages isn't part of our team's process, but it's still interesting to see that nonetheless, because there might be some psychological thing going on there with midterm years. But yeah, I mean, seeing that, we could have some more risks heading into next year. Now, that doesn't mean that the entire market's going to go bearish, because obviously there are bullish trends like silver, healthcare, biotech, those sorts of things. Those have the best bullish trends right now. And so you're just going to have to be more strategic and not just having the blindfold on and playing the previous playbook that has worked over the past couple of years, which is to just, hold Bitcoin as well as other things too. So yeah, that's really what we're seeing right now. And so, yeah, I was buying a little bit of gold. There were a couple other things that we were talking about in our macro investing community that we were purchasing. We are keeping a close eye on Bitcoin. And yeah, that's what I'm seeing here this morning. A little bit of a rebound in select mega caps. Apple just keeps on ripping. Huge bullish trend right there. Walmart as well. Nvidia, pretty weak. Meta, bearish, even though it's having a pop here. Could be getting a little bit of a short opportunity. We will see. Yeah, Meta having a pretty decent volume drop off on this bounce here. So definitely would not be chasing that. Tesla, not really doing anything with that. Same thing, a little bit of a volume drop. Really the only thing that we're seeing today is a bounce in tech. And then everything else is having a little bit of a correction. So you could pretty much characterize this today as a bit of a soft landing optimism bounce. But it doesn't mean we're out of the woods yet with a potential, trend shift in the markets. So with that being said, though, still you have the S&P 500 remaining in a bullish trend. It is still, if we bring up the ranges for today, it is near the top end of the trading range, so not necessarily a big buyer right here. Would rather buy on a dip on lower volume. So, just remaining patient, seeing what the market is going to do. It's okay to just wait and watch for it to, really make a provide an opportunity or confirm a more bullish trend there. But yeah, that's what I'm looking at right here. Volume today for the S&P 500 was still pretty low. So we're still waiting to see what happens once volume comes back, because that'll give you a much better view of, a potential continuation of the trend, right? So really need to see what happens when volume comes back. I definitely don't like how volume has completely dropped off as this bounce is happening, and that we are at the top end of the trading range. So would rather have a big shopping day when we also see a correction in the S&P 500 at the low end of the trading range. It doesn't even have to be at the low end of the trading range. Seeing a correction on the SPY on lower volumes still, that would give me a lot more confidence to go out and do some a lot more shopping with, buying things that are also bullish trend, that are also positively correlated to the S&P 500, and that are also closer to the low end of the trading range on lower volume. So really just want to, even though it might be a little bit of an excitement right now, seeing this bounce right here, just continue to have some patience here. So that is pretty much the message for today. And so we can go ahead and get into some questions. I appreciate everyone for joining. For those of you that are on YouTube, if you could please, hit the subscribe if you're not subscribed already, as well as the like button. Share it with a friend, all that good stuff. It helps the algorithm. I don't know how to do YouTube too well, so hopefully we're going to get to 2,000 subscribers soon, and I can figure out how to actually grow the following on YouTube. But TikTok and Instagram following seems to be going well with the short videos, and so I'll continue to do those. But yeah, maybe 2026 will be the year of getting the YouTube channel going a little bit better there, but it doesn't really matter. I'm not doing this to gain followers. That's just a byproduct of providing the best value that my team and I can. And so the first priority is to make sure that those who are tuning in, which we're thankful for you all, we want to make sure that we're giving the best, risk management data to you guys. So that's what our priority is. It's a little bit different from some of those people who post thumbnails and make content that just blast, fake narratives in your face. But those are the people who are getting views. All right, let's go ahead and get into some of the comments here. First question on YouTube here: how quickly might quantitative easing start, and would that have an immediate effect on stocks and crypto, or would many of these markets continue down and the QE effect would lag behind? That's a great question, Pi116. And really, you have to pay attention to the previous regimes, because what you have to remember is that the Federal Reserve is not a proactive entity. They are reactive. No matter how much the narrative is saying that the Fed is trying to, time the markets, they've never done that in the past, and they are not doing that right now. All the data that they view is incredibly lagging, and they will only react in an extreme way with full-blown quantitative easing when something breaks in the market. And so that's the way that it's been throughout the entire history of the Federal Reserve. You're not going to find one instance where they try and, be more forward with what they're doing and not eventually cause some type of crisis and then respond to it with full-blown QE. And so, to answer your question, what will happen probably is something will break in the markets, which will cause the stock market, as well as things like Bitcoin, a lot of risk assets, to have a huge sell-off. And then in reaction to that, the Fed will then have their massive liquidity injection with quantitative easing. And then after the dust has settled and the explosion has already happened, at that point, then would you be able to find things on discount so that you can gain a good entry for the longer term on a potential V-shaped recovery. And so for all those people that are out there who are saying, the Fed is about to do QE, we got to buy right now. Historically, that has been the opposite of the right time to buy, right? Even if we go back to the pandemic, which is the most recent time where they did full-blown QE, if you were to buy right at the time when they were doing QE, well, you would have suffered a pretty large drawdown. Or if you were to try and buy before they did QE, that's going on before the large drop-off. So again, don't buy the market because they're about to do QE. Buy the market after they do QE and things have blown up. Right? Anytime the Fed does any type of monetary policy, there's a little bit of a lag that happens, specifically and historically, anywhere between 6 to 12 months. So even if the market does explode and they do QE, you still want to wait for the dust to settle and for a rebound to confirm, right? So you have to remember that a lot of these things take a massive amount of time. The ship that is trying to turn right now is a massive cruise ship. It's not a jet ski. So just keep that in mind. Stay patient. Now, that doesn't mean stay on the sidelines because there's clearly bullish trends that are making money right now. But you'll start to see different signs once you have things starting to break. Okay. And yeah, I mean, just don't be on the sidelines and just wait for that to happen because there's still plenty of things that are working very well. And if you need help with that, that's what our community is for. If you already have a community that's helping you out with that, great, stay with them. WIS 6030 says, I think QE would only be necessary during a recession. Yep, exactly. Yes, right there, WIS. Can you talk about the Fed injecting 13.5 billion into the banking system via overnight repos or the SRF hitting 9 billion on one day? Yeah, I mean, this is a result of this tight liquidity environment, and you have to remember that it all has to depend on assets on the Fed's balance sheet. And so let's go ahead and see. Let me open up the list here. Where is the, here we go. Let's take a look at assets on the Fed's balance sheet. Where is it here? Where did I put it? All right, yeah, so here we go. Yeah, I mean, when we take a look at this, we still need to get the update for this week, but we haven't seen a spike in assets on the balance sheet yet. So, I mean, a lot of those different programs that you're seeing, a lot of it is because they are still continuously letting mortgage-backed securities roll off their balance sheet, and then they were taking that principal and then repurchasing treasury securities, mainly bills, in order to maintain the current level. So going back to the bathtub analogy, they are continuing and maintaining the level. So there's still a drain that is being drained out, which is mortgage-backed securities, and they are transferring that risk and rolling that over into treasuries. And so you're going to continuously see a lot of these different headlines saying like, oh, the Fed just injected liquidity. They're not injecting new dollars. What they're trying to do is maintain the current liquidity levels because they are still rolling things off their balance sheet, right? So they're just transferring the principal over into new debt, okay? So that's all they're doing. They're taking the old credit card balance, they're opening up a new card, and then just buying that to zero and then putting that on a new credit card. That's all they're doing. They're not buying new stuff. Okay. So yeah, be aware of all the different narratives and headlines that are out there. It's just ridiculous, It's once you see like the actual data, you come to realize that like, a lot of the stuff that's being promoted out there, it's all just junk to get you to like, buy their newsletter or whatever. And I know I'm saying that because I have my own newsletter as well as community, but like with us, it's not about narratives at all. It's just mainly what the data is doing, as well as we show you how to do it yourself, right? We're not just, presenting ourselves as some type of know-it-all and you have to blindly follow every single pick that we're doing. We want to show you how to do this for yourself so that you can become independent. And, that's the reason why our logo is the glasses. It's akin to that 1980s movie where, you put on the sunglasses and you can see the propaganda for what it is around you. Well, when you put on the, macro optics glasses, you're essentially seeing the markets through a new lens of just what the data is saying. And you can tune out all of the junk that is being marketed to you every single day in order to cause an emotion so that you act on certain things. Okay. A good rule of thumb is, if you read a headline and it causes you to be like, oh no, or oh my gosh, I'm about to miss out. If an emotion comes at you right after you see that, then you're probably being manipulated. So, and I'm not saying that, the Fed injecting liquidity isn't important at all. What I'm saying is that all they're doing is trying to maintain reserve levels. They're just trying not to have reserve levels continue to fall, right? See, when we take a look at the net central bank liquidity here, they're trying to maintain it at 2 trillion. They don't want it to go lower than that. Let me see if I can find, where is it here? Yeah, see that there? Yeah, so $13 billion, $9 billion, that's a drop in the bucket. That is nothing. All right, so we've hammered that. You should stitch some other crazier financial people throwing some advice out there. No, I'm not here to just trash other people. So I'm not going to do that, but I just want to make sure that people are just aware for when they see it, Do you feel the S&P has a good chance of reaching all-time highs prior to the Fed decision? I don't know. You see how you asked that question right there? Do you feel? No. We don't feel things. We just look at the data. Is it possible? Sure. Is it possible that a meteor could strike the Earth tomorrow? Sure. But asking the question that way is just not helpful. Now, if you would like to reframe it in a way that is more constructive, you can say, what are the conditions that you could potentially see where the S&P has a good chance of reaching all-time highs prior to the Fed decision? And in that, I could say, look, if we continue to see the current conditions where you're starting to see inflation have a little bit more stickiness, as well as the soft landing optimism continues to rise from here, then the market might continue to rally on this lower volume. But at some point, volume is going to come back, and that's the risk that you're that you're taking. So, I appreciate the question. It's just you have to make sure that you're rephrasing it so that you're not just asking for me to blow smoke. Is your community for amateur investors or already seasoned ones? I'm a novice/crypto bro trying to invest smarter. We assume that you come into our community without any knowledge of investing whatsoever. So you could be a complete beginner. You've never even pressed a buy or sell button in your life. That's what we, that's what we are assuming when you come in, but obviously a lot of people do come in with previous knowledge and you can just, catch up that way. So yeah, hopefully that answers your question there. All right, let's take a look at some of the comments on Instagram here. Thoughts on some non-US equities, VXUS? What is that? Vanguard International Stock ETF. Yeah, so I mean, this has pretty much been going sideways. Definitely not the same trend as the S&P 500. Looks like volume is attempting to come back here. Yeah, this is something that I definitely would not want to touch because, it seems to be putting in a lower high right here. And yeah, I mean, this isn't something where, you'd want to be buying at this point anyways. But in terms of price level, it hasn't really changed since October. And there have been plenty of other things that have put in new higher highs, right? Such as IBB. Look what IBB has done since that same time. It's up 20%. So why wait around for these assets to, why wait around and just continue to bag hold things when you can just own things that are doing this, right? How do you know when it's time to sell silver? Well, when it gets to the top end of the trading range or goes above it. So, right now when putting up our trading ranges, it's a little bit above the top end of the trading range. This is a great time to sell a little bit in order to buy back lower. Now, whenever we say sell, anytime we're saying that, we mean incrementally, as well as because it's in a bullish trend, you never just want to get rid of the entire position. Now, this isn't financial advice. This is me presenting you the rules for our process. But whenever something is in bullish trend and it goes up, a few standard deviations like silver is doing right now, just, don't be greedy. Take a little bit off the top, and then when it has a little bit of a correction, throw it back in. Compound your returns or compound your position in this bullish asset, while at the same time, you're risk managing it. Oh, it's almost time for Remy's food. Say hi, Remy. You're stepping on my keyboard, sir. Excuse me. So yeah, hopefully that answers your question there. Why did Japan rate change affect our markets? Did it? It doesn't seem to me like it changed anything at all, and that was just a narrative that was being promoted. All right. All right. Yeah. I mean, I apologize for the people who may have asked questions on TikTok. We've reached the limit here, so we're going to go ahead and end the stream. I appreciate everyone for joining. Just as a reminder, we are still having after Black Friday, we had a lot of people who were in the challenge take advantage of our internal Black Friday promotion. And so what that did is that freed up a bunch of seats for the 6-week challenge. And so we'll continue to do the 6-week challenge from now until the end of the month, going into December. After December 31st, so on January 1st, the 6-week challenge will be over. But essentially what it is you get access to our entire partnership circle. And that's where you get access to our trading range models, as well as our other indicators that we've created, full access to our training modules. You get our complete list of ETFs, long-term positions, as well as cryptocurrencies. You get all of our premium research that gets produced on a daily basis, as well as a weekly basis, as well as you get access to myself and the team 24/7. So that's all for free during the 6-week challenge. And so if you guys are interested in that or learning more about it, just book a call with me and we can go over all the details. The link for my calendar is in the description below for those who are on YouTube. For those who are on TikTok or Instagram, the link is in my profile bio. So just go ahead and check out the link there. But I appreciate everyone for joining. Have a great rest of your Tuesday, and we will catch you in tomorrow's daily macro update. Bye, everyone.